Welcome back. You're watching CNBC-TV18 Investment Guide, and we are in discussion with Nikhil Vora about the consumption sector. But before we move on and take more questions from Nikhil, let's first take stock of the FMCG sector. Mangalam is now joining in with the performance and the various factors that have driven this particular sector. Mangalam?
It's the great Indian consumer story, the FMCG sector, which is the fourth largest in the Indian economy with a potential market size of almost 7.5 lakh crores. In this, the products that you and I use daily, household, personal care and food and beverages account for nearly 70% of the industry. In the past, people's increasing purchasing power and increased availability of these products have been the key growth drivers. And these stocks have been D-Street darlings. If you take a look at it, over the last 10 years, we've seen stellar returns. And these stellar returns have actually come by over the last 2 to 3 decades itself. Even underperformers have risen 50% in the last 10 years. We have a handful of reasons for why these stocks have been D-Street darlings. The biggest one, of course, is the fact that there is a large addressable market. Buy what you can touch and feel, said Peter Lynch. Apart from that, there is relatively low capex versus other industries and negative working capital cycle, people getting money before they spend it. All of this obviously reduces the need for any further dilution and leads to higher return ratios, strong balance sheets. Less requirement for cash for daily needs also means that these companies have good regular dividend payouts, but above all these companies boast of extremely high quality, high pedigreed Indian as well as foreign promoters with great corporate governance and management history. Let's talk about the skyscrapers now. The ROE profile for stocks over the last 10 years. On an average, Hindustan Unilever has returned 83% in terms of return on equity. All the other stocks anywhere between 30 to 50%. Now let's talk about the key growth opportunities. The biggest one, of course, is the fact that major categories currently at a granular level still have just 2 to 3 leaders. So more leaders emerging would be a big opportunity. The second one, new growth categories, the likes of men's grooming, etc., would also lead to some growth. Bolt-on acquisitions, like I said, strong balance sheets. So can these companies go ahead and take on good companies and grow them? The likes of HUL acquiring Horlicks as well as Indulekha, ITC acquiring Savlon. It's believed that the next leg of growth for this sector will come from balance sheets, not just the income statement. And the big trigger is also increasing rural income, which currently accounts for just less than a third of the overall market. As rural income increases, demand increases, it could bring another field of opportunity for these companies. But like they say, no good thing comes at a cheap price. And the sector has been notorious for its high PE because over the last few years, we've seen all these stocks trade anywhere between 40 to 60 times. So to prevent oneself from the risk of entering these stocks at extremely high levels, experts usually suggest a systematic investment plan or buying on dips in these stocks. So SIPs and dips, that's the key for the FMCG sector.
Okay, that was an important analysis that Mangalam did for us. Now let's get back to Nikhil Vora. Nikhil, a lot of people believe that perhaps all the listed players might already be saturated levels. So in that case, do you look at, I know you look at unlisted space, but is that a better option?
Anuj, it's very interesting. A decade back in my analyst role, we were trying to struggle or explain and rationalize how a 10 to 15 times price earning is good enough for a consumer business. Today, I think all of us are rationalizing a 10 to 15x multiple, revenue multiple, which is good enough for consumer businesses. It's come at a time when you've seen consumer businesses in generic over the last decade improve their margins by almost 1,000 bips. And that has come despite the fact that volume growth has been extremely stellar across the board. So you've actually had a mix of volume growth, value growth, margin expansion, and market cap growth along with it. So possibly it's the best that one could have ever had. As I look at it today, and the irony is that even theoretically, laggards like ITC, which has almost remained steady or static for the last 7-8 years, still at 7 times multiple of revenues and not of profits. So I think I feel that there will be a redistribution of wealth in the consumer landscape, and it will not be very visible today because, like it's rightly talked about, that this is a negative working business. It's almost a seller's choice, and there is obviously a lot of acquisition capability which a lot of the tier 1 companies will do. and are doing as we speak. So there is potential for them to move from few category leadership to entering into a lot more categories. I think that will happen. So I'm not so worried for the top tier names as much as I would be worried for the second tier names. So if I have to name it in some form, I think players like Imami or Jyoti, I think those are the mid-tier companies which I think might struggle a bit over a longer term period to sustain the values that they have. I also believe that for the larger companies, there will be a lot more distribution of wealth which will happen over the next 5 to 7 years, maybe earlier. Because there are a lot of categories which they've created a vacuum, and the newer players have taken that category pretty much heads on. So if we look at DOs as one category, obviously Vinny's done quite a fantastic job taking on acts of Unilever. You look at dips and sauces, look at Viva, which has pretty much become a market leader in a category which possibly has no other player, literally, right now. Look at feminine hygiene, where it's been a duopoly and there are challenger brands like Pari, which is evolving. So I think there are a lot of categories which are evolving, becoming relevant. And the first mover for a lot of these challenger brands is, I think, a lot more relevant than for leaders to follow them over a period of time. I think that would be a risk. And I think there will be redistribution of wealth which will happen to a lot of these emerging newer players in the category.
So, Nikhil, you're a suave investor and you have the private equity space to look at. But again, I'm going to ask you questions on behalf of our viewers. They're still sort of trying to grapple with the valuations in the listed space. So actually, let me take up some of the questions. One of the queries came in from Shankar, very basic question. He's saying, what are the most important parameters to look at when you're investing into a consumer stock? Then there is Pallavi. Pallavi actually was asking about the same issue, these valuations which are so high. She's saying there's not much innovation many a times. Some of the products are Me Too products. I mean, you've already mentioned your thoughts on that. But when it comes to the listed universe, help out our viewers what to look at, because it's 50, 55, 60 times price to earnings. The numbers stop making any sense beyond a point.
Well, so one core reason why the values are the way they are is just the sheer fact that these are businesses which have longevity, which goes beyond the normal successful business life cycles. So successful business life cycles are all of 15 years now. There are exceptions, but broadly it's at 15 years. In consumer businesses, it's a fair ask to believe that it will go beyond 15 years. So you're paying for longevity, which is the premium that you're paying today. What are the things to look out for? Frankly, I think, as we move forward, and that's what you'll need to visualize, that how the market will shape up. I think if tomorrow the market will become, let's say, around 25% on online, do a lot of existing players have the ability to make a relevant dent in that category or that segment of the market? I'm not too sure whether more than 50% of existing consumer universe has that ability to transient itself into that distribution model. I'm not too sure about that. I'm not too sure about certain categories where players have been fairly large today, but can they remain dominant over the next 5-10 years? Like personal products. I think it's a space which is going to be dominated by platforms and thereby a lot of private label brands of those platforms. So I think there could be a lot of challenges in those categories.
Okay.
Also, any category which is almost a duopoly in India today, I think you will see a lot more challenger brands evolve, and I would be really worried. So if a business is not widespread and they are not into leadership categories in a few more businesses than just one narrow funnel, I think I'll be worried about those businesses today.
Okay, Nikhil, finally, so at 6 cents then, what's your investment philosophy looking at these consumer names?
Anuj, it's pretty much about what we talk about, which is investing in the consumer of tomorrow, today, which is we would want to believe that we can take a shot at what the consumer behavior patterns will be over the next decade, and hopefully invest in a lot of disruptive businesses, could be brands, could be distribution platforms, could be services in those businesses today. Obviously, like I've said, there could be also emergence of businesses which will become relevant over a period of time. So consumer contracting is a big theme that we've always played on and believed in. That's worked very, very well for us. We've done a couple of listed investments in that domain. We've done few new age brands which are very, very disruptive, like Viba or Pari or Bombay Shaving or Vadam Teas, which are pretty much categories which are there for the leaders today. But we think these players are really playing it very differently and hopefully very successfully as they move forward. So it's pretty much about investing in disruption in consumer business today.
So my takeaway, Nikhil, from this conversation is that no longer distribution, but disruption is the name of the game when it comes to playing the consumer story in India. Thank you very much, Nikhil. Very, very interesting conversation. Thank you for making out the time for us today. Anuj?
Oh, yes, absolutely. And I think what stood out for me, invest in tomorrow today. I mean, I think that is something which perhaps you can look at. But Nikhil, thanks a lot. It's always fun to talk to you and always something which we can get out of from you. So thanks a lot for joining us.
Well, with that, we come to the end of this week's edition of Investment Guide. Keep sending us your feedback, comments, queries, anything else you want to know more about. We will see you again next week.